Visa and MasterCard are the best business models you could ever own. They're like a toll bridge on the global economy and spending in general. And they are inflation indexed. If we have 10% inflation, Visa and MasterCard will make 10% more without having to increase their fees because the ticket itself costs 10% more. So it's the best business models in the world. Yet those stocks have been crashing as of recently. Visa is down 7% year to date, and MasterCard is down 8% year to date. I think they're presenting an opportunity, but I have a differentiated views and a consensus, and I don't believe they're kind of generational buying opportunities, and I believe the multiples should be a little bit lower, and I'm going to tell you why in this video. Now, they're going down for two main reasons. The first one is the 1-year cap on credit card interest rates of 10%. They want to cap them for 1 year. A lot of people said this is not going to pass, but I personally don't think why it wouldn't pass. I don't see why it wouldn't happen because both parties, they agree on that, and especially going into the elections, I don't see why that's not going to pass. But the main thesis is that this is not going to affect Visa and MasterCard. It is going to affect the banks because Visa and MasterCard, they don't collect interest rates. This is 100% true. But the banks, they set the interest rate based on your credit score and based on your risk profile. If you have a low credit score, if you don't make payments on time, you're going to have a higher rate than someone that makes their payments on time and someone that's more financially disciplined. So the people that have a lower credit score, if their risk profile within Bank of America is, let's say, 28% interest rate, and if they cap it on 10%, this may not fit in their risk profile, and they might have to cancel the credit cards of those individuals because it's no longer profitable for them to service those individuals. And JP Morgan's CEO said it himself. He said the proposed 1-year 10% cap on credit card rates would be an economic disaster, and said banks would have to remove credit for about 80% of Americans. I don't think it's 80%. I think it's like 20 or 25%, maybe 15%. I don't think it's 80%. But regardless, this is going to affect Visa and MasterCard because if you have less of those credit cards, you're going to have lower volumes for their US-related business. So it could affect them a little bit. And you have a lot of support for that. Like even Donald Trump recently on his speech, he talked about the credit cards and he says they're charging 32% and their profit margins is over 50%, which is true, they're very profitable, and they're going after them. And this is something that Tom Lee said. He said this administration is picking winners and losers, and you have to kind of go with the winners and avoid the losers. And I personally like to buy the losers and wait for a while until they become winners again, which is why I'm interested in Visa and MasterCard in general. Now, for Visa and MasterCard, the big one is the recent proposal of the Credit Card Competition Act, which would stop the out-of-control swipe fee ripoff, which is basically how Visa and MasterCard makes most of their revenues. Now, this is an interesting statistic, is in Europe, the credit card swipe fees, they range between 0.3% to 0.4%. In the United States, it's between 2 to 4%. So this is a massive, massive difference. And if they do something about it, it's going to eat the profit margins and eat within the growth rate and the profitability of Visa and MasterCard. And based on my research, the way it would potentially happen is for bank and card issuers, each credit card would need to have at least 2 unaffiliated network. So either Visa or MasterCard plus another third-party network, and that would pressure fees to go down by giving merchants routing choices instead of defaulting to just Visa or MasterCard. Because the way the current system works is either Visa or MasterCard, the fees are not negotiable and you just have to pay them. You just have to comply with either Visa or MasterCard. You have no other choice, but if you have multiple choices, you have more competition, the fees would potentially go down. So it's not like they're hard capping those fees, like they're telling them you could only charge this much, but they're giving more competition and more choices, which would naturally result in lowering fees for Visa and MasterCard. Now, if I look at the valuation of those companies, MasterCard has always traded at a premium to Visa. Now Mastercard is trading at 28.5 times. Visa is trading at 25.5 times earnings. They're still not cheap, by the way. They were never really cheap, but they're less expensive than they were before. And the reason why Mastercard has traded at a premium is because it's growing faster than Visa. Visa is growing in earnings per share 14%, expected to grow 11 to 12% over the next 2 to 3 years. For Mastercard, they're expecting to grow 16% over the next 2 to 3 years. So this is around 4% more than Visa. And by the way, I'm using fiscal.ai to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But my main thesis on Visa and Mastercard is that I believe they're presenting an opportunity. I believe 25 times earnings on Visa, you could say it's the lowest multiple it has traded at in a while, and it's at its 2024 multiple. But my main argument is they have way many more risks than they had in 2024. So if the business is still the same, Visa is still growing the same, profit margins are the same, everything is the same. The multiple is the same it was 2 years ago, okay? Everything else is the same, but they have the credit card caps. They have, the president going against them and the administration, and they're talking about it, and a legislation on swipe fees, and there could be more legislations. There's also a little bit more competition from buy now, pay later providers. They're becoming more popular, and a few options. People told me in India they use some kind of a system where you could like pay with your phone, and you don't even need Visa and Mastercard. So that's a really big one. And they're facing many more challenges than they did 2 years ago. So my argument is the multiple should be lower to compensate for the risks, given that those companies, they're not growing 20 and 25% earnings per share. So Visa is trading at 25 times, the same multiple it was before. I think given the underlying challenges, I don't see why Visa should not be trading potentially at 23 times, given on a historical basis. Same with Mastercard. Mastercard is trading at 28.5 times. This is at its 2024 low, and it's a decently low multiple. I think it's a decent opportunity, but I think given the risks that were not present before, why the multiple shouldn't be a little bit lower than it was before. I think it should be maybe 25, 26 times earnings. Again, it's hard to measure those things and pinpoint the exact multiples stocks should trade at, but based on my common sense analysis, that's kind of my opinion on them. So for me, I believe Visa and Mastercard here are presenting a good opportunity. Like if you're buying Visa today at, let's say, 25 times earnings, and it holds the multiple, it doesn't get an expansion, doesn't get a contraction, you will likely get a similar return to Visa's earnings per share growth of 11 to 12%. So you're likely going to get a 12% annual return. For Mastercard, it's the same. If they hold the multiple, Mastercard could potentially deliver 14, 15, 16%. That's really not bad at all. For me, I want a lower multiple to compensate for the risks, and for me to have a higher CAGR, so let's say 15, 16, 17%, plus a potential multiple expansion, given the underlying risks. So for me personally, the way I'm looking at it is for Mastercard, now trading at 28 times. If it trades at 26 times, which I believe would compensate for some of the risks, it would be 497. 25 times is 478, which is around 9 to 10% lower than the current price. For Visa, at 24 times, it's 307. 23 times is $294. That would be like a bargain for me. Like if Mastercard, let's say, trades at 478, 475, that's like a generational buying opportunity. If Visa trades at 290s, anywhere 23 times earning, that's, like a generational buying opportunity. I think today they're fairly valued. They could return 13, 14%. But if they get to those levels, to me, they're like no-brainers, and I can't just sit on the sideline anymore, and I have to buy Visa and Mastercard. Right now, I believe they're fairly valued at best, but I just believe that there's more risk than they had before. So why shouldn't the multiple be a little bit lower? So that's kind of my opinion on Visa and Mastercard. I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.